It's really a great pleasure. It's a great honor to moderate such a distinguished panel with such distinguished participants. So let me briefly introduce them to you in an alphabetical order. Let's start with Kurtulus T. Diamondopoulos. She is the director at the World Gold Council and is responsible for central banks and public policy. Then we have Stefan Gerlach. He's the chief economist of the EFG Bank. We have Geoff Kenny, and he is the head of the monetary economic section at the European Central Bank. We have Erik Nielsen, global chief economist of UniCredit, and Jorge Sicilia. He's the same position, global chief economist at the BBVA. And last but not least, we have Jens Ulbrich, the head of general economics at the Deutsche Bundesbank. And I guess you agree with me that this is really extraordinary panel. But just before we start, I will take the opportunity to give some introductory remarks, so to set to setting the scene. So what we see here is basically what we also have heard from Michael, so I can be very quick. It's based on the latest numbers from Eurostat, based on gross savings. So at the end of 2020, we have excess savings here of almost to the tune of 500 billion euros, and this is quite remarkable because this is one of the, I think, the special factors of this crisis, of this COVID-19 crisis. And despite being one of the worst or the worst recession after the World War II, we have seen that during this recession, households in aggregate has become richer, and quite remarkably richer, because if you can see also, as you can also see on the right-hand scale here, these excess savings amount to 4 to 6% in the Eurozone. And the story is not over yet because we have renewed lockdowns in the first quarter, in the second quarter of this year. So households are continuing to accumulate savings more than usually, and in the end, maybe we will see some 700, 800 of excess savings at the Eurozone level. This sounds a lot, and it's a lot definitely, but on the other hand, if you put it in perspective, overall total financial assets of households in the Eurozone amount to some 28,000 billion, so 28 trillions euros. So excess savings compared overall part of the overall of households amount to probably 2%. There's a second observation. It's also quite interesting if you look at the composition of these excess savings. And as you can expect, the bulk of the savings, roughly 2/3 on average, end up with banks. And this is to expect because this is a default option. In the end, if you get your income but cannot consume, so money remains on your side deposit if you do nothing. And this, I think, is also remarkable observation during this crisis. Many households did something. They invested actively the money in the capital markets, and we can see that roughly 1/3 of these excess funds were channeled into capital markets, mainly into direct acquisition of equity. And this is when the rest was then in investment funds. And this is much higher than normal, than in normal times, as we also learned from Mike. This has to do with the low level of financial literacy in households. So normally this is less than 10% that is invested with capital markets or in this kind of risky financial assets. So this is also a remarkable shift in household or savings behavior. Just one additional side remark, because you know I'm from Allianz. This is a sad story. As we have seen, there's almost no money channeled into savings of insurance savings products. In fact, on aggregate, even households at the Eurozone have less money in 2020 into insurance savings products than the year before. So this is something we have to address as an industry, just as a side remark from my side. So, but overall, these two observations pose a lot and a couple of interesting questions related to what we already discussed, that we learned through Michael's and Pietro's introductory remarks. What does it mean for the recovery? This is fuel for the consumption boom, a big consumption boom, even adding the spark to again, or will nothing happen? We'll just see excess funds will remain in the balance sheet of the households because they expect rising taxes down the road. That means that many households will behave in a Canadian style. The second question is what happens to the savings pattern? This is just a temporary change in saving behaviors, permitting time, permitting money that a lot of households started to play with equities, with stock investments, not so much as an investment, but more as a pastime, similar to the developments we seen in the US, Q GameStop phenomenon, GameStop episode, or is this really the beginning of something new that households finally came to grips with a low yield environment, realizing that they have to change their return risk profiles and that you have to invest in or save in a different way in order to get some decent returns? And last but not least, it's also quite important for me, also echoing what Michael said in the beginning, is there any policy measures policymakers can take in order to make sure that these funds find their way to a more productive use, that they do not remain idle at the bank deposits, but will be invested long term to the green digital transformation, will help to modernize the EU economy. Something not only for the savers, bringing some decent returns, but also have some social returns in modernizing the whole economy. I think this is a couple of interesting questions we will try to tackle in the next 80 minutes left. So without further ado, I will the panel. This shares their view, and first I would like to ask Stefan just to open the floor with your thoughts about some of these aspects. So over to you, Stefan.
Thank you very much, Arne. So what has happened? Well, consumption has collapsed. If you focus at Europe, many people look at the US data. I'm going to look at European data here. So consumption has collapsed more than disposable income, because disposable income have been supported by a whole range of government support programs. And if you look in the lower left-hand corner there, I have three measures. Actually, I have the Eurozone in blue, but I split up the Eurozone into something which we think of as a core. That's largely Germany, weighted average of what I think of as core economies, and periphery, and that is France, Italy, and Spain, and a few other countries. And I also have the UK. And what you can see here is that the core of the Eurozone has had a smaller fall in consumption than the periphery, and the largest fall here has actually been in the UK. If you look at gross disposable income in the middle, you see pretty much the same story. The core economies here, remember that's largely Germany here, seen the smallest fall in gross disposable income among households. It has been more pronounced in the periphery, and has also been very marked in the UK. And if you look on the right-hand side here, we can see that actually there's quite a bit of savings going on in general in the core of the Eurozone. I only have shown the last year here, but if you were to extend the graph to the left, if you'd like, these lines are essentially horizontal. So there's a lot of saving going on in the core countries, and less in the periphery. Now we've seen a surge in savings in both of those groups, and an even larger surge in saving in the UK, which actually saves the least in normal times. So we have this picture of a lot of savings last year. If we change slide there, I think the next question is, will there be a surge in spending? And here I think the key issue is sort of one's mindset. Is the glass half empty or half full? A lot of people and a lot of commentators talk about forced savings or perhaps excess savings. And the idea here that using these terms is that there is some type of disequilibrium here. People have piled up money. And, with that sort of mindset, it seems natural to say, well, spending will probably surge as the economy recovers, and this disequilibrium can be corrected as people can go out and spend again. Some people look at forced savings during World War II, and they say, oh, there was a sharp increase in consumption after World War II. Some people are like accounting more than economics. They go and look at, see how much the saving has fed into people's bank accounts and M1 and so on and so forth. And they say, well, whoops, we have a surge in bank deposits and it's going to be spent, and so on and so forth. Now, I think several factors point to gradual unwinding. And rather than go through those, I thought Piercarlo Padoan gave an excellent summary in the beginning of why it seems reasonable to expect that this unwinding will be gradual. So let me skip that in the interest of time and go to my final slide instead. So next slide, please. So I think it's better to think of this thing not as a disequilibrium phenomenon, but rather sort of a positive wealth shock. You won on the lottery, and you ended up with some extra money. Now, what will you do then? Well, if you think of ordinary preferences, in a first year university course, we talk about homothetic preferences with income elasticity. Demand is equal for all goods. In that situation, you will increase the spending on everything proportionally, right? So that suggests you should partially increase current spending, partially increase future spending, and partially reduce borrowing. And what I find extraordinary was when I looked in some work at the New York Fed on the U.S. stimulus payments and how they were spent. Now, there were three sets of these, and then the dates that you see there are from the month of the New York Fed survey of consumer spending. So the one is that I marked in June 2020. There's actually the economic impact of the payments made as a part of the CARES Act, and they were made in April 2020. The middle column is the stimulus payments made under the CRRSA Act, or the Coronavirus Response and Relief Supplemented Appropriations Act, and they were made in December. And the last column here were those under the America Rescue Plan, and these are sort of what people plan to spend the money on. And what is so striking here is that these are almost exactly 1/3 each. People have a dollop of extra money and they spend it. A third goes to current spending, a third goes to future spending, a third goes into debt reduction. And I think pretty much that is where we will end up also here. Some of the spending will be spent, a large part of it will be saved, and a large part will be used to pay down credit card debt, even car loans, and mortgages, and so on and so forth. So I think I'll just stop there, and we have lots of commentators, and I'm sure we will have plenty of questions later on. So in the interest of time, let me stop right there. Thank you, Arne.
Yeah, thank you, Stefan. I guess the scenario that you just sketched is also very much to the likening of the ECB. But before, we should probably dig a little bit deeper into the motifs, into the macroeconomic motivation of these excess savings. What was the reasons to build these excess savings in the first place? And I think this is also very interesting, very important to understand these motivations, because it helps probably also to understand what will happen next with these, how these excess savings will be used in the future. So that means over to you, Geoff.
Thanks very much, Arne and Stefan. Delighted to be here in this panel on savings behavior and the pandemic, its implications. There's so many dimensions to this savings debate. We have, involuntary savings. We have passive savings, maybe. We have excess savings, as Stefan has just been talking about. We, of course, have dis savings. We have precautionary savings. I just think it's a great way for us to think about the macroeconomy, the outlook, and the risks there, in particular, because it brings into focus the macro financial linkages that are so important in understanding economic dynamics. So I will take a perspective on the household sector, and I will draw on a new online survey that very fortuitously in January 2020 we launched at the ECB, and it's an online survey. So it's a survey that we have been able to do in a very uninterrupted way during the COVID pandemic. As in the slide just passed, these are of course my own views, and I take full responsibility for them. So could move to the next slide, please. So the first point I want to stress is, the very substantial heterogeneity in the pandemic's financial impact across households. To measure this in the survey that I just described, we have elicited individual level household concerns about the financial impact of the COVID-19 pandemic on the household's own financial situation. And we do so on an 11-point scale, with 0 being no impact at all, and 11 being a hugely strong concern about the financial impact on households. So the data really do highlight the very significant heterogeneity, both across countries, as Stefan has also mentioned, with Spain exhibiting the highest concerns, and Germany and the Netherlands, the lowest concerns across the euro area countries. We also see very substantial heterogeneity across different demographic groups. Across age groups, the young have the highest concerns in terms of the financial consequences of the pandemic. Also, women have higher concerns than men, quite consistently and significantly higher concerns than men. And lower income households have higher concerns compared with other parts of the income distribution. Lower income and also liquidity constrained households. So, I mean, the bottom line from this is very much that, while everybody is in this COVID storm, it's clearly not the case that everybody is in the same boat. And in a recent paper, together with my colleague Dimitris Georgarakis and Tullio Giapelli and Dimitris Christelis, we've kind of shown how really important it is to take into account this heterogeneity in trying to understand the pattern of aggregate consumption in the euro area over the course of the pandemic. I would maybe go to the next slide, please. I mean, one last comment in relation to this heterogeneity that I've just described is, of course, it clearly has consequences for the savings behavior as well. And this shows up also in the survey. So in line with what Stefan has just emphasized, you see that about 20% of the respondents to the survey are accumulating savings, increases in their wealth over the course of the pandemic. You have about 20% who are doing the opposite, who are dissaving, who are, eating into their retirement nest eggs or drawing down on debt. And then you have a large fraction in the middle who have had no effect on their savings or are not saving and who have unchanged saving behavior as a result of the pandemic. The other point I want to make, if I could go back to the earlier slide, the second point I want to make relates to the motives behind the savings patterns that we observed and what we can tell from this new online survey. Of course, getting a handle on these motives is really important for tracing out the impact and the implications for how those savings will unwind and where they'll end up. And of course, it's clear that this type of involuntary savings behavior, this forced savings behavior, has been an important part of the increase in savings for some parts of the distribution of households. But the motive I want to emphasize here that we clearly see from the survey is that the precautionary motive is also highly relevant, and it's linked to aggregate or macroeconomic uncertainty. And we address this in the survey by trying to directly elicit a measure of precautionary behavior. And what we have seen is that over the course of the pandemic, this measure of precautionary, of the strength of the precautionary savings motive has increased in response to the COVID pandemic. You see here on the left-hand side chart of this slide, our measure of the precautionary savings motive between October 2020 and January 2021, which I think was an interesting period. Insofar as I think it was a kind of a good news, bad news period. On the one hand, we were starting to get good news in relation to the vaccines. On the other hand, there was also some bad news in relation to the increasing incidence of the COVID pandemic and the risks of second and third waves of the pandemic across countries. We were also starting to learn about the logistics of the vaccination program as well, and how quickly it would be possible to procure the vaccines and, of course, distribute them logistically to the population. And what you observe over this good news, bad news period is clearly an increase in the precautionary savings, the strength of a precautionary savings motive between October and January 21. On the right-hand side, I just make a reference to a recent research paper as well that we've undertaken with this new survey. And there we try and look more directly at the effects of uncertainty. Again, this is something we did with the data in September, where we used a randomized controlled trial to examine and induce exogenous variation in uncertainty in our data. and then trace out its effects on consumption. And what we found there is indeed a very substantial impact of uncertainty, of macro uncertainty on consumer spending that was also quite persistent, in line, by the way, with the paper that we've just seen presented a moment ago. Another aspect that I think is important that we document in this paper is also the heterogeneity in terms of the effects of uncertainty on consumption and consumer spending. And in particular, we document that employment risk appears to be particularly important here as well. So consumers working in sectors that are particularly exposed cyclically to the pandemic shock exhibit the strongest precautionary effects on their consumption. And then I would go to the last slide very quickly. So last slide is really, I want to make a point on the policy mix in this complex environment, where we have this strong heterogeneity in the pandemic's impact on households, and also in terms of household savings motives. And the point I want to make is that, targeted policies can deliver the strongest stabilization benefits and support the recovery that is in prospect. Monetary policy has reacted in a very timely manner to the pandemic shock, and it has also recently responded to the changes in the environment as the pandemic has been transmitted to the economy. But fiscal policy is really the most equipped to be able to target those sectors most impacted by the pandemic. And you can see this in the bottom left chart on this slide, where, for example, we plot various indicators by income quintiles. And what you see is that the lowest income quintiles, for example, have experienced the largest drop in hours. And they are also the most constrained in terms of their access to liquidity. But they have received the highest shares in terms of government support measures. So on the right-hand side, just as a final remark, I wanted to point to the link between these fiscal support measures and the precautionary motive that we discussed before, or a potential link. There's no causation here, this is just correlation. But something we've observed in the survey is that those households who kind of believe the fiscal measures to have been most adequate. So we assess on a subjective basis the household perceptions about the adequacy of the fiscal measures and the fiscal support measures that they have received, and the strength of their precautionary motive. We kind of have observed this negative association. So those who perceive fiscal support to be most adequate are exhibiting less precautionary behavior. And this was a point that President Lagarde made in a speech at the ECB forum on central banking earlier last year. And with that, I think I can conclude and thank you very much. Very much looking forward to the rest of the panel discussion.
Yeah, thank you very much, Geoff. Very interesting. Also, I found here results a little bit sobering because it really confirms the issue that we have here a recession that overproportionally affects women, younger people, and the poorer households. So this is really something that also Michael mentioned in his keynote speech, that we have probably aggravated inequality. And on the other hand, also that the support measures by the policy support measure can be clearly do better, can be more targeted, because if you look at, if you correctly read your slides, that if you look at the highest income groups, twice as many households receive income support as have liquidity constraints. So that seems to be something that is more like a windfall profit, maybe even for this high income group. So there seems to be room for improvement for policymakers, something also maybe we should come back to in our discussion in a moment. So far, we have concentrated on the household sector, but I guess there are also other sectors as well with excess savings, as Mr. Padua mentioned in his introductory statement. So to speak of some kind of additional cash buffers. So I would like to hear more on that issue as well. So over to you, Erik. The floor is yours.
Thank you. Since this is a panel, So let me start to get the discussion going and get my fellow panelists ready for the debate. Let me make 3 very quick comments. I fully share Geoff's point on policy measures and how fiscal policy is the most effective one. And I hope, and there are signs certainly we will do more. I've written a lot about what I think is an insufficient fiscal response this year in Europe, not last year, doing very well, but I never understood why we are seeing some withdrawal this year. Stefan, I would say that I would hesitate and not call them lucky. In America, probably so, because so much cash was given out for things that were not very targeted. But as I'll show you in a chart in a second, I think there's the excess saving in Europe is indeed to a much lesser extent, if at all, due to a cash payment. And then, Arne, I have to say, with these extra savings, I think I heard you say that we have to get back to a time when you get a decent return on your savings. That sounds like a monetary tightening to me. I think we have to, at the end of the day, get to accept that if you take no risk with your savings, you probably shouldn't expect a whole lot of return or decent return. So let me address what I think are the prospects of how we get the savings back into the economy and starting to help the recovery. And I'll actually speak a little bit on the households and then on the corporates, as you asked me to do. I think we should be very careful not to draw too firm conclusions about how this all will pan out. These charts here you have seen already, or in different variations of the savings ratio, how it has exploded both places. The separation between the European countries levels are different, as my chairman said in his introductory remarks. But here we are. And this chart is what I would focus on for one moment. As you can see here, we have estimated the sources of what, in spite of what Stefan doesn't like to call excess savings, is the build-up. And there is a substantial difference between the US and Europe. And inside Europe, there is some difference between Italy and Spain on the one hand, and the others on the other. And this is where, Stefan, I think one shouldn't really think about these savings as having won the lottery, certainly not if you are in Europe, because this illustrates the build-up by basically cutting back on spending. Now, there are two key takeaways, I think, from this chart. There is the issue, the US versus Europe. You could argue, I think, that Europe has more pent-up demand because you have simply cut your consumption and boost the savings. But as Mr. Paduan said, with his joke about haircuts, it only takes one haircut to get back to normal. But it goes beyond that, right? A lot of the consumption, or the drop in consumption, is in the services, almost exclusively in the services, in travel and hospitality. But how many times can you go out and eat and have a drink? Would you really catch up? How many times can you go on vacation? You have to take free time off from your job. So I really believe there is a long way back in that sense. So I don't think, while this one suggests that there's more pent-up demand in Europe, I'm doubtful that we will see a big explosion and a released consumption maybe for a month or two, but not so much after that. So in a way, I would suggest that for Europe, what we probably would have is this immediate reaction, as you can see now, at least from anecdotal evidence here in London, from the opening of restaurants, that people come out, but then it sort of flattens off again. And to make this sustainable in a longer trend line and bring savings all the way back to where they were, which I think is not the most likely scenario, I would argue that we need more fiscal support in order to households to make up for this and feel more comfortable again. And for that matter, for the business side, I think this is important in order to reduce, not eliminate, the scarring of the economy as we've gone through. Let me say one word on this as I bridge over to the corporate story now. You hear a lot of discussions or suggestions by some of using the opportunity to get rid of zombie companies. It reminds me sort of a bit of the Schumpeter story, right, of creative destruction. But I find it very misplaced for the simple reason that you really don't know what is zombie in the middle of a pandemic. And the simple answer or question I would encourage people to answer if they feel that way is that the first one that's obvious to me is that 75% of the airline industry in the world should stop being around. But do we really believe that? I don't. Hopefully we'll fly a little bit less than we used to, but the picture you have of the corporate pain across sectors today is very unlikely to reflect the longer term future, I think. But that's another discussion maybe. Now for the corporates, I'll make two quick comments and then I'm done. The first one is on this chart here. A lot of emphasis has been on the great indebtedness that we have seen grown up in the corporate sector, taken through the banking system with the help of the guarantees. But the point here is, as you can see, the difference is quite substantial between gross and net debt. And the reflection of that, of course, is that corporates have taken the money from the banks that were lent with guarantees from the sector and stuffed it into deposits. So I think this is the key point to take away. The debt is a big way, but in net terms, not so much. This suggests to me that we will go into a period of deleveraging. The black line is high compared to any time until sort of the 2011-12 or thereabout. And we know that when these numbers are elevated, get a 4- or 5-year period of deleveraging as companies bring down the debt numbers. It's not the red line that's important here. So I would argue that deleveraging, yes, a break on growth and investment, yes, but not a bigger fundamental crisis in the corporate sector. It's not something we should fundamentally worry about, but the banking system will see higher non-performing loans if the guarantees are withdrawn too fast. A big policy issue we can talk about later. But I wouldn't from this conclude that we get more than a bit of a break on the growth because of the deleveraging. The other side, of course, is this chart I showed you already, that elevated deposits in the corporate sector. Whatever investment companies will do, they have a lot of liquidity around. That would be help to bring down the debt, of course, on the one hand, but also finance a good deal of the investments and working capital as we go forward. And that's lucky. And that's my last point here, because my view is that while we in the banking industry are flattered by having been told that this time around the banks were part of the solution instead of part of the problem, I suggest that that's a over-flattering of us. The heroes here were the fiscal policies and the guarantees, and helped by the ECB, of course. Banks, of course, helped by having the network and did the work, but yes, it's good that banks have more capital, but it's not the higher capital level after the financial crisis that made this possible. It's the guarantees. And what you saw even yesterday from the ECB's lending survey is indeed that credit conditions are tightening and companies are not demanding for a lot of credits. So I think we are heading into a period where we could see quite a bit of stress developing on the banking system, depending on how policies are unwinded. But I'll leave this for the policy discussion. And since I work in a bank, I have to show you my disclaimer. Let's hear my comment, but then I will end here. Thanks a lot.
Yeah, thank you very much, Erik. And just before we continue, Stefan, would you like to reply immediately to Erik's comments? Or
go ahead and just throw in a very quick comments so far. I think Geoff was quite right in pointing out precautionary savings. I had that on my slide that I didn't show in the interest of time. But of course, precautionary saving is not excess saving. It's not forced saving. So a big chunk of this has nothing to do with excess saving and forced saving. It's people rationally save more because they worry about the future. With respect to Erik, on this thing of the lottery and so on and so forth, it is true. It's not they haven't gotten the money in the same way as if they won the lottery. But that wasn't my point. My point was that the economic reactions to having these savings that you at some future stage realize you don't need, is you will react to those savings as if you had wanted, as if they had occurred to you from the lottery. So it's not a statement of where the savings come from. It's a statement of what you will do with them when you sense a smaller need to have stocks of savings in the around. And finally, Erik is absolutely right on in his comments on zombies and airlines. That's the best example. Lots of people talk about zombie companies and so on and so forth, but I thought Erik's point was absolutely right on. It's very difficult to see, particularly in the middle of a pandemic, what is a zombie company. The airline example is just great, and I will steal it from you, Erik. I will use it myself.
You can have it.
It's beautiful. Thank you.
Okay, thank you, Stefan. No, just from my side as well, I mean, don't get me wrong, with the decent returns, for sure, we mean that people have to be invested more in risky assets. Even we, as an insurance company, try to convince our customers to do more, to get rid of guarantees, of 100% guarantees, and to take more risk with the investment, because otherwise there will be no returns left. And another remark I get from the chat box, we talk a lot about these precautionary savings, forced savings, excess savings. What is meant by excess savings is simply the difference between the level of savings we can see at the end of 2020 compared to a situation where we had no corona crisis, no pandemic. So it's just a contrafactual, extrapolating the savings trends before the crisis and then compare the results in 2020 with the contrafactual savings level of end 2020, what we would see without any pandemic. And this difference then is called the excess savings, additional savings, and this is fueled by precautionary, because people feel more cautious about the future, and is also fueled by forced savings because they were not able to consume as much as they used to be. But again, thanks again, Erik, for your very important intervention. I think I also very much like this comparison between the US and Europe, because right now we look at the US and we see the US is well ahead. The vaccination goes much better than here in Europe. We see the opening of the economy is well advanced, and we see, if we look at the economic data, for example, if it be retail sales or labor market statistics, this is really skyrocketing. But I guess if you really look at the structural differences between the support measures, and we can, as is expressed by the structure or the sources of the excess savings, then we can really do not assume that the same will happen here in Europe. I think it would be a premature conclusion from my side to assume that a similar development will unfold in Europe over the summer when we have vaccinated half of the population and we start to reopening. It will a totally different dynamic, in my view, than we see right now in the US. And this has to be also to put into the context of the sources and structure of excess savings. So having said that, I think we have now discussed a lot of these excess savings on the European, on the Eurozone level, but I think it's also important to zoom in a little bit more on specific country characteristics, because it's also important to have more granular data to understand much better the dynamics of these savings and how they might impact the future course of the recovery. So that's then over to you, George.
So thank you. Very glad to be here. Thank you for the invitation. More than focusing on Spain, which is of course what I'm going to do, the main point that I want to make, for whatever it's worth, is to try to put some numbers using saving equations as regards whether we can get a better grasp of what excess savings or forced savings are. Now, I think we can do that. In any case, we're going to find out, as you can imagine, that there is a relatively large residual that we cannot explain, and that, in a sense, we can give it a number. So for us, there's a little bit of a difference between forced savings and excess savings in this definition, but the magnitudes are still relatively large. So here are the numbers that we have put together for Spain, right? So as Stefan said in the beginning, what we have had across the board is a significant reduction in consumption, and at the same time gross disposable income has not declined as much. So when you take that in an accounting way, what you get is what can be called, in a sense, forced savings that you have not spent. So here the question remains of why and what are you going to do when things change, and you can have different answers depending on how much weight you give to different measures, such as whether you want to smooth consumption or you need to smooth consumption because your income has declined, so you tap from savings, or you dissave or get credit, as Geoff was also saying, or whether you decide to save because there is a significant amount of uncertainty to which you're much more sensitive in terms of your pattern behavior. And then, of course, there is the fact, though, simply that you have been constrained to consume because you have not been able to get out and consume in what you want to consume, or that you didn't want to change your consumption patterns to other goods in order to use that extra money to consume other goods. So what we try to do is to let the data work. So we use models that we have to Spain to try to see whether we can find an empirical answer to this. So we kind of use a partial error correction model where we basically put as variables the usual suspects. So we use income, wealth, aging, availability of credit for the economy, uncertainty as measured by unemployment, interest rates. We can even try to put some Ricardian effects there, and we just estimate the equation, and we see what cannot be explained by fundamentals and cannot be explained by what we called precautionary, and we get this eventually this amount, which is what we called excess savings for Spain, around 60 billion euro. That's slightly above 5% of GDP, and of that we estimate that around 2% of GDP are precautionary savings, and 3.5% of GDP, a huge amount, forced savings. Now, once you do that, the question remains, right? So the question remains insofar as whether you call it precautionary. There might be a time where you don't want to save for precautionary reasons, whether you call it forced or non-precautionary in this chart. You have to take a decision of what you're going to do with the savings, or whether you are going to use them more to replenish your wealth and to consume. And of course, I guess that there is a huge difference as regards whether you have this money for a long period of time or a short period of time. All this initially goes to wealth in a sense. And I guess that if you have wealth for a sufficiently long period of time, chances are that you're more likely to see that as wealth in comparison to amount of time. So now the issue here is that there is a big uncertainty, as many others have commented. I just plugged in some numbers here as regards the uncertainty. All these models, in a sense, are kind of linear. So we here put in the table what if those 60 billion are considered additional income, or 30 billion, and how would that translate into an additional consumption if we assume that the baseline is that all those precautionary and non-precautionary savings are kept. And the difference is kind of staggering, right? Because in 1 year, we would be talking a rate of growth of consumption that would be 2 percentage points higher, between 1 and 3 percentage points higher. Given the importance of consumption in GDP, this can have a huge impact in terms of growth. So there's a large uncertainty as regards what will happen with this saving and how much is going to transform into consumption. There's of course there are many sources of uncertainty. One is related to whether we're going to have more problems with the COVID. Another is whether your pattern of consumption and savings is going to change due to what you are seeing in the COVID and what you expect to happen in the future in terms of whether you might be able to retrain yourself to go back to the labor market or not. So in a sense, there's a great uncertainty, even though we might try to put this down and bring the uncertainty down into a traditional equation of consumption, right? We have an uncertainty related to the variables, but also an uncertainty related to the models. So I guess this calls to paying much more attention to high frequency data in order to see how this is evolving and trying to see real time whether the expectation that you have as regards consumption and savings is changing once the COVID constraints disappear. And this is kind of something that fortunately nowadays we can do using big data. So we can have daily data on many things with information that we have, for example, coming from the clients in the bank, of course, anonymized as you can imagine, and we can build proxies of savings. We can build proxies of consumption using credit card and other type of data, and we can also get into more granular issues that are going to be important as regards what will happen with savings and consumption. Now here I just plugged for your kind of amusement some charts with this data in which we kind of build a proxy. Is not a proxy of savings because we're using deposits and savings can have other means, but we think this is a proxy of liquid, in a sense, liquid savings, which is probably the one that is especially in certain age brackets or investment sophistication type, much more likely to go back to consumption. And you see that there are important differences here. What you have is the ratio between deposits and income, change in deposits and income. And what you see is that, I mean, of course, you see a different pattern in the quartiles of income, but you also see a very different patterns when you go to ages. As you can see, those that are over 65, their deposits are increasing much more than their income. I guess that there is, in a country such as Spain, little uncertainty as regards income for the elder because of the pension systems that we have. So this might be forced, but this of course doesn't mean that these people are going to spend more in services. It will be much more difficult. So we are going to have different propensities to consume depending on many things, right? On income, on age. We see this pattern also in gender. This might, of course, be related to the fact that this crisis, in terms of employment, has affected more in Spain women than men as compared to the previous crisis, in the global financial crisis, in which the majority of people that were hired in the housing sector were male, while now in the services, close proximity businesses, more women are employed. And then, of course, we can go more granular also in terms of the geography of what is happening with deposits versus income in regions, right? And although you certainly need not know where those regions are, I mean, the ones that are at the bottom, when you take away Melilla and Ceuta, which are very specific cases, but you have Canary Island, Balearic Island, Murcia, Valencia, Catalonia. The ones in the bottom are the ones that are basically related to, with a relatively high share of tourism, where income has declined significantly. And what we have probably seen is that even though there has been help to many families, there has been a significant drag in deposits, probably in order to, because they might be either liquidity constrained or something similar. While on the top you have Castilla and Leon, which has nothing to do with tourism, and basically there most of that savings or that proxy of savings is probably related to people that have not been able to spend. And I guess that the trick will be in the future, and the future is soon. We're going to have to try to find in this granular data different propensities to consume in order to have a better view of what will happen to consumption in the future. I will leave it there. Thank you.
Countries, but now we learned that also the international, the domestic differences between different regions are probably even more pronounced, and I think it's something also that policymakers have to keep into account or take into account when they devise their support measures in the months to come. So just another deep dive, because we now have a deep dive in one of the countries, in Spain. Now I would like to have a deep dive more into the savings pattern and the savings behavior, savings products, because normally we can say in times of crisis, people demand safety, and that means they buy gold, maybe. At least in Germany, that's definitely the case, because you know Germans always, the next hyperinflation is just around the corner. So you better have some gold bars in your cellar. So what happened this year? What happened during the COVID-19 crisis? Over to you, Kurtulus.
I think we are in the same page in terms of our attachment to gold. Let's start with how gold performs during the systemic risk times then. In this chart, I put together 10 recent systemic crises, including COVID. And as you can see in this chart, and the gold bar is representing gold's performance, gold has had performed 9 crises out of 10. And only time gold couldn't have this performance, negative performance, was during the dot-com bubble. So what makes gold perform this way has lots of reason, but the major one is it is dual structure. Because of this, gold has many different demand sector coming from different sector. Investments, it is a reserve asset for the central banks, the demand coming from jewelry, demand coming from the technology as well. So all these demands are derived from different factors, coming from the economic expansion to the risk and so many factors. Because of that, gold behaves and performs well during the crisis. And I don't want to go further other details, like it is liquid, it is nobody's liability, it doesn't have credit risk, so we can count many other things. And if we go to the second slide, I will show there how retail investors view gold. And first of all, certainly investors has psychological component attachment to gold, and they say they feel comfortable with the gold, and they want to own it for the long term. And our studies shows that investors invest in gold because of the store of value, wealth protection, and also they see it as a liquidity provider for them for unexpected events. It can be personal events like health issues. It can be these kind of systemic times. And in 2019, end of 2019, we made a survey. We surveyed 18,000 people across the world, from mature gold markets, India, China, till Russia, which is not mature like them. And we asked them their opinion about gold. This shows the percentage of those people, how much the percentages they were agree with these factors. Certainly, their attachment to gold, feeling secure, valuing them it for the long term was important, but the most important factor, as you can see here, is gold seen as a safeguard against inflation and currency fluctuations. And at these days, these factors are very important. And in fact, when we look at the investors' behavior, attitude to invest in gold in 2020 has these factors in it. And my last slide, I will go into the real investment numbers in 2020. First of all, the gold demand increased for 3% for the whole year, but there was a behavior difference between the countries, regions in the East and West. While Asian countries liquidated their gold, sold their gold to pay for their daily consumption, Western countries accumulated, purchased more gold. Let's say in Taiwan, these sales, gold sales in Q2 and Q4 reached 40 tons of gold, which was a big amount. And in India, let's say, investors were more attached to their jewelry since they invest mainly in jewelry way. They didn't want to sell their gold, but they loaned gold. They gave collateral their loan to reach liquidity. So in this chart, we put top 5 countries in 2019 and 2020 in terms of their bar and coin demand. As you can see, Arne here, Germany is a star, and from around 90 tons, they reach 163 tons. And this is a record amount in our data set, which was last time reached 142 tons in 2011. They said they invested gold as a safe haven, wealth protection, all the usual reason, and they said they protect themselves against inflation, and they said against the low interest rate as well. And United States first time joined this top 5 countries, and they also US Mint has been showing reporting lots of interest, and these interests are like historical high levels, like in January the Eagle bullion coins print reached 6 tons for the gold. And then these are, as I said, the very historical levels. And Turkey is not, of course, missing. As you can see, from around 53 tons to 121 tons it reached. And again, this gold demand was mainly their Republic coin and the pure gold bars. And they wanted to protect themselves against the crisis, and they also moved their wealth or cash, I should say, from bank because of the low interest rate environment to bring the gold. So I think gold was performed well, and because of that attract lots of demand. And we are going to publish our gold demand trend report next week, and we are hoping that we will have lots of insight about the investors' behavior. And I think I am done at this point.
Yeah, thank you very much, Kurtulus. Looking forward to your new report. I think it was very interesting to have a spotlight of just one aspect of this changing savings behavior. And now we come to the end of our first round of interventions. And last but not least, we have Jens with us. So Jens, the floor is yours.
Well, thanks, Arne. Given that I'm the last on this distinguished panel, I will stick to the rule that everything has been said already, but not by everyone, and especially not by me. I will try to focus in my remarks on what happened to savings behavior, what will happen to savings behavior, and what does that mean in the context of our bread and butter monetary policy business as a staff that is setting up a macro forecast, especially forecasting aggregate demand and inflation. Mostly I will focus on developments in Germany, but I will also make some references to the euro area developments, and I think giving more the macro perspective that should augment what Geoff had already said. Well, in a nutshell, what happened to the euro area savings ratio and to the German savings ratio is it was profoundly influenced by the COVID shock. Private consumption plummeted last year. The savings rate nearly doubled in the euro area. In Germany, it was similar, but somewhat less pronounced. Here, the private net savings ratio increased from 11% of disposable income in 2019 to 16% last year. But if you look at the quarterly profile last year, you see that it skyrocketed in the second quarter to 20%, and then with loosening of some of the containment measures, it came down to 13% in the third quarter. I think that profile makes clear that savings are closely linked to the course of the pandemic and to containment measures. And that leads immediately to the hypothesis that the bulk of savings are forced savings. And to get somewhat deeper insight into the savings motives, in Germany, we used our own household survey, which is similar to the ECB ones. We asked 2,000 households last year, and from these 2,000 households, nearly one half responded that they have reduced private consumption expenditures. Asked for the motives of their reduction, out of this group, 49% mentioned simple non-availability of goods and services. 34% mentioned fear of catching the virus, which I would argue is a kind of precautionary motive, but not the classical one. 20% stated classical precautionary motives, and for only 16%, it was a consequence of a direct drop in income. I think it is also noteworthy that 45%
Jens, we don't hear you.
Have we lost you?
Can you hear me now?
Yes.
Yes?
Yes, please
No,
repeat
yeah.
the last
Okay.
minute.
I think
I don't know.
I think 45% of these households responded, and I think that is noteworthy that a lot of private consumption was not needed anymore or not regarded as useful anymore. And I think all that underlines the argument that the largest part of the rise in savings is forced. It also shows, I think, that income support measures to stabilize disposable income worked quite well. While private consumption in Germany dropped 5% last year, disposable income increased by roughly 1.5%. And given the third infection wave in Germany and the containment measures still ongoing and expected to be tightened soon, I think it's a fair assumption that this year's savings rate will stay at roughly last year's level. If that were the case, then at the end of this year, additional savings of roughly 250 billion in Germany would have been made. That's approximately 10% of disposable income compared to a counterfactual without the pandemic. For the euro area, I think the relevant number could be up to 800 billion euro. From the asset side, the bulk of the savings fly into liquid assets and contribute to very dynamic money growth we observed since a couple of quarters. Our own estimates indicate that roughly 70% of savings are in monetary assets. The rest is mostly equities and investment shares. But for macro forecasters, of course, these developments create significant challenge in setting up a baseline forecast for the next couple of years. So if you take Germany, here private consumption has a share of 50% of GDP. In other euro area economies, that is even higher. If you look at the additional savings 2020-21, this is for Germany a magnitude of 7% of GDP. Thus, what happens to additional savings will shape the baseline GDP outlook for the next 2 years, and this constitutes one of the big uncertainties surrounding any current macro baseline. I think there are two basic questions, and this has, I think from my point of view in the panel until now, not emphasized enough. The first question is whether and how fast the savings rate returns to its pre-pandemic level. And then the second question is, to what degree will additional savings be decumulated? Or in terms of the savings rate, will there be an undershooting of the desired medium-term savings rate over the projection horizon? And I would argue there are good reasons to give different answers to these two questions. I would argue that there are good reasons to assume that the savings rate will return to pre-crisis levels swiftly once the pandemic is conquered. At least the bulk of the higher savings rate is due to forced savings closely linked to the pandemic, and the traditional labor market precautionary savings motive does not play an overly important role. But regarding the second question, I'm less convinced, and I would recite myself into Stefan's camp with that. I'm skeptical that additional savings will be decumulated as swiftly as the savings ratio returns. Of course, there are arguments supporting a swift decumulation. According to these arguments, once the pandemic is over due to a successful vaccination campaign, why should households want to hold more savings than desired? Moreover, I think if households regard these savings as delayed income, then we know that the marginal propensity to consume is quite high. So there could be a swift decline in the savings ratio and an undershooting, and that would drive aggregate demand and also increase price pressures. But as I mentioned, I'm residing more with those being skeptical. Nearly half of the German households, at least, who reduced consumption, as I said, argued that they view previous consumption as not useful anymore, or quite a lot of that. I think it's not perfectly clear how to interpret this, but it could at least signal lasting shifts in private consumption habits. And furthermore, I would stick to the view that households regard additional savings not so much as lacked or delayed income, but more as additional wealth. And we know that the marginal propensity to consume out of wealth is significantly lower than to consume out of income. Moreover, marginal propensity to consume should also be low when the additional savings were made by households in higher income brackets. And that's exactly what happened in Germany. And maybe just looking at the private savings behavior is too short-sighted. I think the other side of increased private savings is decreasing government savings. All these fiscal stabilization measures have led to a massive swing in fiscal positions. For Germany, the swing was nearly 6 percentage points of GDP last year, and private savings also increased to absorb new government debt needed for fiscal stabilization. And if households, I think Arne, you referred to that in your first questions, if households behave recalcitrant, and they know that they have to pay for the additional debt later, that's why to accumulate additional savings now keeps them to pay future taxes. And a final argument for not believing in a rapid depletion of additional savings rests, I think, on the empirical knowledge we have that private consumption after a recession behaves very dynamic when the recessionary foregone consumption was goods related. But a lot of the current reduction in private consumption is not good related, it's services related. And this does not speak for a significant additional consumption boost, or in short, the journey is not made last year and this year, the restaurant visit cancelled and the beers not drunk are largely bygones, I would argue. So taking all that together, what does it mean for setting up a macro forecast? What we expect is a strong recovery of private consumption in the second half of this year and next year. The savings rate should return to pre-pandemic levels next year. So without any doubt, in the recovery in the second half, private consumption will be the main engine and the main driver. There might also be a slight undershooting of the medium-term savings rate, but only moderately. And from a monetary policy point of view, I think this should not lead to a market additional pressure on aggregate demand and on inflation. This is also the reason why the current high rates of money growth may not be directly linked to immediate or future price pressures. Of course, there's a lot of uncertainty. What you can do to deal with that uncertainty in your macro forecast is design model-based scenario analysis. I know ECB colleagues have done so. They have assumed different passes for the savings rate over the projection horizon. And I think the outcome of all of that is, even if you assume that large parts of the additional 800 billion euro additional savings will be depleted until the end of 2023, which is the end of our forecast horizon, the impact that has on GDP is roughly 1% compared to the baseline level. And for inflation, a slight additional inflationary pressure, but still inflationary outcomes at the end of 2023 that are below the implicit policy target of close but below 2%. And with that, I will finish my remarks.
Yeah, thank you very much, Jens. As expected, an excellent wrap-up of all the arguments and discussion we had so far. For the sake of time, I would now like to open the discussion to all participants. Nonetheless, I would like to start because we have now more or less built this consensus that we do not expect a consumption boom, that we do not unleash of pent-up demand immediately over the summer, so that most of these excess savings will stay for the time being at the household balance sheet. So what can policymakers do about it? Is there any way to incentivize, with say tax advantages, to channel these savings into more productive use? Because as we learned from Michael, it's basically only the better of households, it's the better educated households that take advantage of the investment opportunities. It's not the aggregate, it's not the average household that is able to do this. So is this something policy measures should be taken to incentivize this kind of more sophisticated, more smarter savings decisions? And the other question, what comes across my mind, I mean, we talk always about these black and white. You can have the savings as savings or you consume it. What is if the savings or most of these financial assets are converted into real assets? If this is fueling another housing boom, because I mean, there's a lot of incentives now, working from home, so everybody probably feels the need to have a bigger home, a bigger flat. So this could even then exacerbate the inequalities and the housing price boom. That would be also have some kind of social dimensions in my view. These are the two set of questions that come across my mind. So who would like to start?
I can start with your second question as regard the real estate. I think it's an especially relevant question because when you think in terms of housing, it's a combination of investment and consumption, right? Especially if you're spending much more time at home. So in a sense, it probably has a plus, the fact that we are already seeing how people are looking for more space, renovating their home, increasing the demand for housing in specific locations, either with a little bit of garden or terrace. So we're already seeing this, and in fact, if you have a look of what is happening in the credit of the banking sector in many countries, what you see is that the main mistakes in the ability to model credit that we have, for example, are taking place in the housing market. I mean, it's precisely there where we are seeing much more demand than what we would have expected following our models. So I think that part of that saving is clearly going to go to housing as a combination of consumption and wealth.
Just to carry on the issue of the housing, I think if the pattern that I understand that most people expect with more work from home also in the post-pandemic world, I suppose that might actually help in the housing market, equaling out a bit of what we've seen, this seesaw effect where the cities have the big appreciations, but a little bit further away from the cities, there were poorer demand. So presumably, at least what I hear, and I've seen in articles written, if, and this is a big if we are going to work some days from home, people would be more inclined to accept a longer commute those couple of times a day or a week when you come in. Now I have a question for Jens. If I understood you correctly, the issue I wanted to ask for clarification was the issue of potential Ricardian effect, which is something I personally have some doubts about. It sounded to me like you had a different sequence than I thought is the right one. It sounded like you have this fiscal explosion, and then what do people do? But the fiscal explosion happened, as far as I can see, in reaction to the private sector move. So in many ways, I mean, look at the current account, for example, where we have surpluses throughout Europe. We saw basically a disappearance of the private demand, and the public sector steps in. Now, if one is a believer in the Ricardian equivalence, then maybe that doesn't matter. I have to say, though, I am probably on above the average income and at age where I have more savings than many others. I still, here in Britain, even though they have run terrible fiscal policy, I somehow still don't think they're going to hit me so much. So at least I'm not going to put more money aside in anticipation of Boris Johnson's craziness. But I wonder if you could elaborate a little bit on this stuff.
No, Erik, in referring to Ricardian behavior, I just wanted to present one of the arguments you can hear underlying the view that there will not be a fast and rapid depletion. And by the way, I just brought it up because the panel moderator explicitly asked for taxing away excess saving. So I thought if you would go for that, then Ricardian behavior might not be as unlikely as it seems. But to answer that tax question, I would not prefer to tax individual households, but to tax companies who usually administer these kind of savings, especially life insurance companies, Arne. No, just kidding.
Can I make a comment on Jens' presentation, which I thought was very, very good? And I was struck by the fact, and this is something that I missed, that there are in fact two effects of savings here that we have to talk about, not one. And the first one, as he said, is the return of the savings ratio to its pre-crisis level. That's a flow effect. And the second is what happens with the pent-up savings. These are in fact analytically two separate effects that I had not really focused on. So that is a very useful distinction for thinking about this problem. I was struck by this, if I understood you correct, Jens, you said that 45% of the people asked said that consumption was simply not useful anymore. And I assume that it's people that, like me, I'm not going to work, so I don't need to have suits to see clients and so on and so forth. But that, I think, is probably, that's not forced savings, right? That's, you see no use for this stuff. So that suggests, to me, that is an equilibrium phenomenon. That is, some say you don't see a need to spend money. So, that's not compulsory in a sense.
No, you can make an argument that this signals shifts in consumption patterns, but I think it's difficult to interpret these answers because it could also be related to the pandemic. It could also be related to simple non-availability of consumption possibilities. So it's
yeah, but that was your first point, right? You said first was for 49%. You said was non-availability. Yeah. So I thought this was something separate from that. But
no, we allowed double answers in that.
Okay.
Summed up the numbers, you would have seen it's we allow multiple answers, so it's not perfectly clear. But I would at least argue that part of that 45% would clearly signal that these lasting shifts in consumption might play a role, and there might be scarring effects of the pandemic on consumption.
Okay, thank you very much. For the sake of time, because the chat box is already quite full, I would like at least have some questions from the other participants. And I think one we steered some interest was the question about the housing. So there are two questions related. Do you see a risk of a price bubbles in stocks and real estate? And do you expect a housing price boom? So I think this would be something maybe to Geoff. Can you answer from the ECB point of view? What's your view? Because I mean, a housing price bubble is always how financial crisis starts. I mean, how it begins. So, is there something to be concerned about, or is this where the ECB or you presently are still quite relaxed?
I can comment a little bit on that. I completely agree that the response of the housing market to the pandemic is a very important issue for us to look at. And some of the evidence we've seen is, you know, it's a little bit quite contrary to what most of us might have expected to happen when our economies were hit by such a large negative shock, that we've actually seen some buoyancy in housing markets. And of course, I guess this reflects the relative interplay of, you know, demand and supply in these markets. But the supply side of these markets has also been impacted by this pandemic. The construction sector has been affected quite a lot by lockdowns and so forth. I mean, I wouldn't comment, you know, so explicitly on bubbles or not, but actually I would like to take up the more general point that was also made by Erik earlier on, relating to financial vulnerabilities down the road when we move out of the crisis environment. And I would certainly agree that this is something that needs to be taken extremely seriously, particularly when we move out of this, what I would call the coronavirus crisis phase. Hopefully when we get through the vaccination period and the removal of lockdowns and reach a more stable equilibrium, then we may start to observe indeed some of the financial vulnerabilities also in the non-financial corporate sector on the balance sheets of banks that are certainly important risks that need to be considered going forward. And then let me react also to kind of, you know, really agree with Jens on the importance of the involuntary savings. I emphasized precautionary behavior in my presentation earlier as an also. I kind of fully agree with Jens that the bulk of what we've seen on the saving side of the distribution has been due to this involuntary repressed consumption associated with lockdowns and so forth. And the precautionary, I just wanted to make the point that we do also have this evidence linked to the precautionary behavior. And I think it's one of the factors that is pointing to the fairly consensus view here about no return to the type of consumption boom, roaring 20s scenario that you, Arne, had mentioned earlier as well.
May I, since I'm in a different position, I'm going to volunteer on the bubbles. There are no bubbles. There are, first of all, you have to remember, for a bubble to be dangerous, it really has to be credit fueled. And it is not clear, if I'm not mistaken, but Jens would know it better than me. I think in credit in housing credit in Germany has grown by 5-6% or something. It's not. It's a little elevated, but nothing sort of that you go back and look at. And on equities, I again, unless you think interest rates are going to go up a lot, and therefore you discount differently the earnings, it's very difficult to argue. That doesn't mean they're not segments, particularly in IT and places in companies that never made any money, that are been trading at incredible numbers. But that's not, I don't think, systemic. Housing would be systemic, and I definitely think one needs to look at it, but it's not credit fueled. So I would be relatively relaxed.
So then, thank you very much to all the panelists. I think I enjoyed it very much. I hope all the participants enjoyed it as much as me. So thanks again to your contributions, and hopefully see you again at some of these SUERF conferences, be it online or be it virtual.
I think we have brought some structure to the topic. What I personally take along is that various arguments actually speak in favor and against forced and precautionary saving, feeding into the post-crisis recovery. It remains uncertain to what extent such unwinding and over what time profile the unwinding might actually happen. There are undoubtedly strong differences across demographic groups. Income, wealth, job security, gender, age, etc. were mentioned. They will all influence the post-COVID savings and spending behavior. Some missed spending, like services, will be permanently lost, leading to a permanently higher savings stock. Depending on various countries' sectoral structure, the depth of their crisis, and various other features, notably the adequacy of fiscal responses that was mentioned, may also affect savings behavior in the future and the speed of the recovery across countries. I am sure this debate will stay with us for the years to come. I'm already looking forward to the research which will be done, say, in 5 years, exposed once the story will have played out. To conclude, let me thank all speakers and moderators and all of you for your interest and your questions. Bye-bye and take care.
Bye-bye, Ernest.
Thank you. Bye.
Thank
Bye.
you.
Everybody.
Bye. Thank you.
Bye.
Bye.